Now, if you will see the types of carbon pricing instrument from the compliance and voluntary perspective, under the compliance, there is one which is a market-based mechanism, which we call it as an emission trading system. You set a benchmark. The industries who are emitting more will have to buy the credits, and industries who are emitting less than the benchmark or the targets will be issued the carbon credits. So there is a trading between the good performers and the bad performers, and the market will operate. The other type of carbon pricing instrument is the carbon tax, where directly the government applies the tax on the CO2 emissions. Right now, this is not in India, but if we talk about, say, South Africa, Singapore, and some of the other countries where they have the carbon tax on the amount of CO2 emissions from their direct consumption, say scope 1 and scope 2, direct fuel consumption, you will have to pay the carbon tax. And then there is an energy tax. Rather than pricing the CO2 emissions, you put a tax on, say, kg of coal, or say on fuel, etc., where you collect the excise duty. Or like in India, initially we had a National Clean Energy Fund, where every ton of coal you were charging 400, the government was charging 400 rupees per ton of coal, and then that fund was parked for, say, green initiatives. So from that perspective, the difference between the carbon tax and energy tax is that carbon tax, you directly tax the CO2 emissions, but under the energy tax, you account or tax the amount of energy consumed by the company. So this is how I would say the CPI works from the compliance perspective. And under the voluntary carbon market, usually there are three forms of voluntary carbon market. One, where it is a federal run government programs like China and Korea, where they have domestic offset programs. Then there is a clean development mechanism, and very recently the CDM has transitioned to the Paris Agreement crediting mechanism, which is operated under the Paris Agreement and by UNFCCC. So that is also there. And then voluntary carbon markets like Vera, Gold Standard, where the companies register and you can buy credits for your offset requirement. But if you will see under the CPIs for the compliance market, it is based on a polluters pay principle. The more you emit, more you are liable to pay. And then if you are pricing the CO2 emissions, then definitely this will discourage industries to reduce the CO2 emissions or encourage them to move away from CO2 emitting technologies. And then as you price the carbon, it creates an incentive for the companies to reduce the emission, because they will be having cost savings in their operations. So that is why I would say the carbon pricing instruments are very important. Now, every country has recognized that if we talk about, say, ambitious goal, which countries are setting, say, European Union or say China, Korea, etc., everyone recognizes that the carbon pricing instruments can play an important role in achieving the Paris Agreement goals. And you will see that in the last 5 or 6 years, there has been a lot of developments in different countries where CPIs are introduced. Right now, if you will see, 36 countries are implementing the emission trading system, and around 37 are carbon tax type. But there has been a lot of research in the last few years where the research bodies or say academia or say government are highlighting that emission trading systems are contributing to reducing the emissions at the country level. So that is why I would say the CPIs or say emission trading system or voluntary carbon market plays an important role in the climate action of the country as well as individual industries as well.